The Mathematics of Eliminating Income Taxes, a Comprehensive Analysis. Throughout his political career, President Trump has consistently advocated for the complete removal of individual income taxes, a notion he has continued to discuss post-inauguration, suggesting it may be more than just a campaign promise. To evaluate the feasibility of this proposal, we must delve into the financial dynamics at play. In 2024, the federal government collected approximately $4.89 trillion in taxes but spent $6.99 trillion, resulting in a deficit that is covered through borrowing. This scenario can be likened to earning $100,000 annually while spending $150,000, necessitating a $50,000 loan. A historical perspective on income taxes. Historically, the U.S. did not impose individual income taxes until 1913, aside from a brief period during the Civil War. The introduction of income tax was initially targeted at the wealthy, with a mere 1% levy on the top 1% of earners. Fast forward to today, and the average American dedicates nearly half of their income to various taxes. The notion of abolishing income taxes might seem like a financial windfall, but practicality suggests otherwise. In 2024, individual income taxes accounted for nearly $2.5 trillion of federal revenue, roughly half of total tax collections. The role of Social Security and Medicare taxes. Beyond federal income tax, Social Security and Medicare taxes contributed another $1.7 trillion, or 35% of tax revenue, making up 84% of federal tax collections when combined. Corporate income taxes and excise taxes account for just 11% and 2%, respectively. Therefore, eliminating income taxes would mean cutting 50% to 85% of federal revenue, which was about $5 trillion in 2024. With government spending at $7 trillion annually, this would necessitate drastic spending cuts to avoid ballooning the deficit. Economic implications of eliminating income taxes. Despite the potential economic boom from tax elimination, such a measure would be challenging to implement. Individuals might enjoy increased disposable income, enhancing their quality of life, but the resultant deficit would require borrowing. This borrowing, often from banks, expands the money supply, potentially leading to inflation. Consequently, while individuals might retain more income, inflation could erode purchasing power. Hypothetical scenarios and economic outcomes. In a hypothetical scenario where Trump eliminates federal income taxes and possibly Social Security and Medicare taxes, even with substantial spending cuts, a $2 trillion deficit might persist. This would be financed through borrowing, introducing new money into circulation and driving inflation. Thus, the perceived financial gains might be offset by rising costs. The complexity of government borrowing. The U.S. government's reliance on borrowing, whether through direct purchasing power transfers or banks creating money, underscores the complexity of eliminating income taxes. While there are advantages to financing government spending through inflation rather than taxes, such as reducing IRS overhead and encouraging productive economic activities, the transition could be fraught with challenges. It's crucial to consider the broader economic implications, including potential financial repression, which might restrict individuals from safeguarding their wealth against inflation. Congressional approval and tax policy changes. Ultimately, any significant tax policy change would require congressional approval. While there are signs of fiscal restraint, the government spending model, where every dollar spent is extracted from taxpayers, remains unchanged. Taxation, in essence, involves coercive funding of government services, distinguishing the U.S. from other nations where tax systems are more voluntary. Protecting wealth in an inflationary economy. In conclusion, while shifting towards inflationary financing could offer individuals some choice in wealth protection, it presents its own set of risks. Investing in inflation-protected assets like gold, Bitcoin, or real estate could shield wealth, but historical precedents suggest the possibility of restrictions on asset ownership during inflationary periods. Therefore, proactive investment in such assets might be prudent before potential regulatory changes.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.